Tech stocks have been getting cooked in recent weeks as the shares fall. The sector continues to shed jobs as some of the companies trim themselves to keep pace. But is the worst still yet to come for the sector? Let's bring in Paul Meeks, who's the portfolio manager at Independent Solutions Wealth Management. Paul, I want to get your perspective on the tech wreckage that's taken place here. And given the annexation to some of the Fed movements, where we could see some continued downturn for tech shares.
Yeah, unfortunately, it's been grisly, and I'd like to tell a nice tale about a quick turnaround, but I can't do that in all honesty, because I think what's happened so far, and you just showed the graphic, the tech spider, the XLK, is down 29% year to date, but that has all come, or essentially has all come from just a contraction in valuation as rates rise. We haven't seen the potential second leg down, which is a reflection in this country and around the world that we have a recession, which would take down expected revenue, earnings, and cash flow. If and when that happens, then you have lower earnings multiplied to a lower PE ratio, and unfortunately, that could be your next leg down. Now, I think if we do have a next leg down, it won't be as severe as what we've had so far. But on the other hand, I think it's still too early to call the bottom in tech. If you're a long-term tech investor, that's pretty cool, but I would go in slowly and deliberately, maybe in 4 or 5 tranches over time. And I think we're also entering a new era in which you really have to focus on more valuation-sensitive tech names versus some of the heroes of yesteryear in which valuations, frankly, didn't matter.
So, Paul, look through the prism of the tech-heavy NASDAQ, let's say. How much, how overvalued is the NASDAQ here at current levels?
Oh, I still think that if we have a recession, which is my expectation, or at least we should plan for it and hope that we're pleasantly surprised and have a soft landing, we could drop another 15 to 20% at least on this second leg that I'm referring to.
Okay, and so this is also a sector that for some of the largest names, they are heavily exposed to advertising revenues. And typically during some of the cost restructuring that marketers and the teams of companies that are putting together their own plan to go out to consumers, when they're pulling back that spending, that directly impacts some of these largest blue chip tech stocks that we're talking about here. And so how long do you think that can continue to impact them, especially in a rising rate environment where every company is trying to figure out, all right, how is this going to hit our balance sheets?
So we know that there's a morph going on in digital advertising. And of course, if we enter a recession, total advertising spending will drop, right? We just don't have the appetite to boost these budgets like we had in the past. And so, yes, I think that Alphabet, because it has some other things going on for it, might be relatively unscathed, but they'll still be damaged. In the meantime, Facebook, even though the stock is historically cheap, I mean, it's ungodly cheap, you still have a situation where I don't know what their long-term business model is. And so until that is resolved and until we have lower estimates to reflect a U.S. recession, I'd probably still stay away.
Paul, the average investor out there, they have only known some of these big cap tech stocks. You just mentioned Facebook. That's one of them, to only go up. And now they're at home and they've seen their trading portfolios just eviscerated here, down 40, 50%. What's the action plan? What should they be doing right now?
Yeah. So what I would do is I do think that you should have a cash hoard. I think if you go into the sector at all, please, please, please be long-term focused. And then say you wanted invested $1,000, maybe you go in 5 tranches of $200 each, right? Because I'm not going to be able to pinpoint the recession. But when we do see on Wall Street, and it'll be pretty clear, wholesale estimate revisions lower for sales and EPS for all these marquee companies that you're referring to, then I can at least say if we have a formal recession or not, that has been recorded in stock prices, reflected in stock prices. And then, yeah, it might be time to become a better buyer.
Paul, we were talking about the possibility that Europe may already be in a recession. And so for some of these companies that also are reliant on revenue coming in globally, and trying to figure out exactly where that's already potentially impacting them in current quarter and future quarters as well. You kind of round out the broader global recessionary risks there. How much more should we also be looking for these companies to come out with guidance that also factors in the global scenario?
Excellent question, because of course the typical tech company is even more globally focused than the average U.S. Domiciled company. And of course, not only the factors that you just mentioned, but also currency risk, right? We've seen some marquee names such as Microsoft talk about the beating that they're taking just based on the currency translation. I think the proof in the pudding will what happens in the next quarter's conference calls, right? So this quarter is going to end June 30th for most companies. They'll start to report their earnings the second or third week of July. That'll bleed into August. And at that point, they should have some comeuppance. I hope that they are savvy enough to properly reflect a recession, not just here, but abroad, lower those numbers. And then when we get those numbers low enough, then I could do some valuation work and say, hey, is it time to buy?
Well put. Paul Meeks, portfolio manager at Independent Solutions Wealth Management. Good to see you. Have a great weekend.